What's up, guys, and welcome to Wall Street Millennial. Over the past 5 years, Tesla stock has increased more than 12-fold. For any hedge fund unfortunate enough to have shorted Tesla, this position has taken them to near bankruptcy. On this channel, we've covered some of the biggest hedge fund managers who shorted Tesla, including Greenlight Capital's David Einhorn and Kynikos' Jim Chanos. While their Tesla short positions have undeniably been painful, both of these short sellers continue to manage billions of dollars and are still well respected on Wall Street. In this video, we're going to go over a hedge fund manager whose Tesla short position has been so disastrous that his reputation on Wall Street has been completely ruined and his hedge fund has been reduced to managing just a few $1,000,000. If you haven't guessed it already, we're talking about the world's saddest short seller, Mark Spiegel. In this video, we'll go over Spiegel's rationale for shorting Tesla, why he was dead wrong, and what the implications were for his hedge fund. Before we get into the video, I'd like to thank our channel members for their support. Members get access to our non-time sensitive videos one day in advance and get to vote on some of our video topics. Mark Spiegel is the founder and managing member of Stanfield Capital, a New York-based long-short equity hedge fund. He started his career working in the commercial real estate industry and later on worked as an investment banker at Piper Sandler for 6 years. In 2011, he left Piper to start his own hedge fund, Stanfield Capital. As a self-proclaimed deep value investor, he longs stocks trading at very cheap valuations and shorts stocks that he thinks are overhyped and therefore overvalued. He is also a macro investor. This means that he positions his portfolio based on his outlook for the global economy. Spiegel is an OG Tesla short seller who first started shorting the stock as far back as 2013. At the time, Tesla stock was valued at $26 per share, adjusting for the recent stock split. He explained his Tesla bear case in a Seeking Alpha article. At the time, Tesla's only car was the Model S, which had a high price point of $80,000, so it competed mainly with luxury brands. Spiegel saw increasing competition from the legacy automakers and thought that Tesla would quickly lose market share. For example, Porsche was about to release its hybrid electric Panamera car. The Panamera was a plug-in hybrid and had a battery range of 24 miles, after which it would run on gasoline. Spiegel reasoned that 24 miles of range is enough for most people to get to work and back. So the Panamera would be a viable alternative to a fully electric Model S. As it turned out, forward-minded consumers wanted fully electric vehicles, not hybrids. Despite the increasing supply of hybrid vehicles on the market, the Tesla Model S continued to grow strongly throughout 2014 and 2015. It stopped growing in 2016, but this was only due to a temporary supply bottleneck stemming from the ramp-up of Model X and eventually Model 3 production. The great decrease in demand that Spiegel foresaw never materialized. The Tesla short was one of Spiegel's highest conviction plays. From 2014 to 2018, he published dozens of articles on Seeking Alpha explaining why the company is overvalued. In 2018, Stanfield started to significantly underperform the broader market. They lost 17.7% for the year, while the S&P 500 was only down 4.4%. At the time, the Fed was winding down its post-recession money printing policies, and Spiegel foresaw a massive market crash that never materialized. This, along with some deep value penny stock plays, caused his fund's underperformance. His Tesla short position didn't hurt him that much in 2018, as the stock was only up a few percentage points. But he was in it for the long haul and had no intention of covering his short until Tesla reached his price target of $0 per share. He reiterated his bear thesis on the company with 3 main points. Firstly, Tesla has no moat and the legacy automakers will eventually take share from them. Their losses will soon explode and they will run out of money. And lastly, Elon Musk is untrustworthy, always overpromising and underdelivering. Shorting Tesla was his highest conviction idea, and he doubled down on the short position, thinking that it would save Stanfield from its recent abysmal performance. In May of 2018, he gave a presentation at the Case Learning Short Selling Conference explaining his thesis.
I mean, think about this. A lot of people buy Teslas to sort of show off at the country club, right? I'm driving my electric Tesla. You pull up in your Tesla, and this guy pulls up next to you in the new electric Porsche. You feel like a total schmuck. The next weekend, you're at the dealer. Get me out of this thing. Get me one of those. That's what's going to happen. 2 years after that, Porsche's building a crossover based on the Mission E. So that'll be out in like 2020. Mercedes, its first electric SUV comes out next year called the ECQ. They've been winter testing it. By the way, none of these are vaporware cars. You can go on YouTube and find hundreds of these being driven in like winter testing on the Nuremberg racetrack, all this stuff. I mean, these are all real. Mercedes is then going to launch an electric version of the S-Class. I mean, look at the interior of an S-Class compared to a Tesla, right? If you had that choice and you want an electric car, I mean, this becomes a no-brainer, right? This is out in 2 years. Mercedes wheels out electric car roadmap, car and battery factories everywhere. I mean, this is Daimler, a real company, spending real money all over the world to build electric cars. I mean, they alone would crush Tesla.
Tesla was the trailblazer for electric vehicles, but by 2018, the legacy automakers were finally starting to pull their heads out of the sand and roll out EVs of their own. Luxury brands like Porsche were making cars to compete with the Tesla Model S. Mass market brands like Hyundai were also starting to make low price point EVs to compete with the Model 3. Of course, his prediction turned out to be dead wrong. As of the first half of 2020, Tesla still has more than 80% market share in the US, and the top 3 EV models are all Teslas. Another factor Spiegel failed to consider is that EVs still represent a tiny percentage of total vehicle sales. In 2019, EVs only represented 2.5% of global new vehicle sales. So even if Tesla did lose some market share within EVs, there is still massive room for growth as the world switches to electric. Being the first mover in electric vehicles, Tesla built up an extremely dominant brand and is now practically synonymous with innovation and green technology. And with the Model 3's starting price being under $40,000, it is still very competitive with other EV options. The rise in electrification over the past 5 years isn't an EV revolution, but a Tesla revolution. Even Citron's Andrew Left understands this.
And as a short seller, the most important thing you have to do is check your thesis all the time and see when things change. And when they started with Model 3 and the launch and the production and the numbers and how they were eating from the top and the bottom, and I realized it wasn't an EV revolution in this country. It was a Tesla revolution, that people want to own the Teslas.
He often pointed out that Tesla was losing money and the losses appeared to be accelerating. But this was merely the result of the company investing for growth that will pay dividends in the future. And in 2019, these investments finally paid off, with 4 consecutive quarters of positive free cash flow. In late 2019, things really started to get bad for Stanfill. From October of 2019 to February of 2020, the stock increased more than 260% as Model 3 deliveries continued to outperform expectations, and retail investors were increasingly piling into the stock. The violent rise in share price was especially bad for Stanfill because in addition to being short shares of Tesla, there were also short call options. In December of 2019, Stanfill was down 11.4%, while the S&P 500 was up 3%, mostly resulting from its Tesla short. For the full year of 2019, the fund was down 6.5%, marking its 3rd consecutive year of negative performance. In light of the heavy losses, he reduced the fund's equity short position down to 10% of the total portfolio. In the past, the Tesla short has been in excess of 20% of the portfolio, which is an extremely concentrated position for a short. He also stepped up his verbal attacks against Elon Musk's company, calling it a major league fraud. Importantly, he also maintained his short call position. He added a 4th item to his Tesla bear points. You can tell the losses were really causing him pain because he lashed out at Elon Musk, directly calling him a fraud-committing pathological liar. In the 3rd quarter of 2018, Tesla unexpectedly turned a $153 million profit, while Spiegel was expecting a $300 million loss. Instead of giving them credit for the quarter, Spiegel said that the profit was engineered via accounting games. Specifically, he says that Tesla was under-reserving their warranty provisions. When a car is sold, the automaker generally provides a warranty. If there are any mechanical defects in the car within a set amount of time, the automaker has to pay for the repairs. For example, if the automaker estimates that 10% of vehicles sold will at some point initiate a warranty claim, and on average each claim costs $10,000 to repair, they have to set aside a $1,000 warranty reserve for each car sold. This counts as an expense and reduces net profit. Short sellers like Spiegel point out that Tesla sets aside less warranty reserves than other automakers, which in their view artificially inflates their profit and amounts to accounting fraud. However, it turns out that Teslas break down far less frequently than other cars. An analysis by Warranty Week shows that in 2018, Tesla's warranty claims amounted to 1.1% of sales, while Ford's warranty claims were more than 3% of sales. In a lot of ways, electric vehicles are simpler than internal combustion engine vehicles, and therefore are less likely to have mechanical issues. Tesla's relatively low warranty provisions simply reflect this reality. In fact, Tesla's auditor PwC actually brought in warranty accounting experts to look at this very issue. The experts found that the company's warranty reserve calculations were appropriate given their estimation of future claims. In January of 2020, Tesla stock really started to go parabolic, more than doubling in the span of less than 2 months. In January of 2020, Stanfill was down more than 10%, while the S&P 500 was about flat. About half of this negative performance can be attributed to 2021 690 strike Tesla calls that he was short. At the beginning of the month, they were valued at $14. As Tesla stock started to soar, the calls skyrocketed and he covered the position between $25 and $30, leading to a roughly 100% loss. He also reduced his Tesla equity short position to around 5% of the portfolio. He laments that before he started shorting Tesla, Stanfield had a long track record of outperformance and he wants to reclaim that track record. He plans to shift his focus away from shorting and take Stanfield back to its roots of finding deep value penny stock long positions. He closed out all of his other short positions except for Tesla. In the letter, he repeats the same tired Tesla bear thesis and claims that Tesla is now the biggest single stock bubble in the whole market. But Stanfield's trouble were only just getting started. From January 31st to August 31st, Tesla stock increased more than 240% as their deliveries continued to outperform despite the pandemic. They announced a 5-for-1 stock split in August, which inexplicably sent shares soaring even further. For the month of August alone, Stanfield was down more than 15%, almost completely attributable to his short positions on Tesla and the QQQ. Year to date, Stanfield was down 21%, while the S&P 500 was up almost 10%. This is a more than 30% underperformance. The recent performance was so bad that it almost completely wiped out the gains the fund made in its early days. Since inception, Stanfield has compounded at just 2.2%, while the S&P 500 compounded more than 13%. If you had invested in Stanfield at its inception in 2011, you would have made a 21.7% total return by August of 2020, compared to a 215.5% return had you invested in the S&P. In the investor letter, he points out that the S&P 500's forward price-to-earnings ratio is around where it was at the height of the dot-com bubble, implying an overvalued market. Foreseeing a market crash, he continues to hold significant short positions despite the fund's awful recent performance. He continued to be short shares of Tesla as he views it being more overvalued now than ever. After the announcement of a 5-for-1 stock split, the stock soared, adding $230 billion to the market cap, despite no other meaningful news being announced at the same time. Over the second half of 2020, he actually made somewhat of a comeback and finished down 11.5%. This is still a massive underperformance compared to the S&P 500, which increased 18.4% in the same period. His long positions were actually up a lot in 2020, but the underperformance of his shorts, namely Tesla and the QQQ, caused his negative return. He still thinks that the stock market is in a giant bubble, and once people are vaccinated and actually start spending money, the Fed's money printing will finally cause a massive increase in inflation. He points to record-high stock market valuations as evidence that markets are overvalued. Spiegel has been calling the stock market a bubble for the better part of the past 4 years, but during this time, the market pretty much only went up. From inception to the end of 2020, Stanfield's compounded annual return has been just 3.3%. The lack of performance has made it very difficult for Spiegel to raise capital from investors, and he now manages just $7.4 million at most, which is tiny for a hedge fund. The sad part about Mark Spiegel's story is that he's actually a pretty good stock picker. Most of his penny stock long positions have outperformed the market. For example, one of his major holdings in 2020 was Avient Networks, which increased more than 400%. If he was a long-only investor, he would have made millions of dollars for his investors, and he could have become a legendary hedge fund manager on Wall Street. Instead, he made the unpardonable mistake of betting against Elon Musk, and his career paid the ultimate price. Alright guys, that wraps it up for this video. Make sure to check out our second channel, WSM Research, where we post DD videos on high-growth tech stocks. If you like this content, make sure to hit the like and subscribe buttons. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.